DA Davidson analyst Michael Baker joins us. Michael's got a buy rating on the stock, price target of $395. Was this a surprise that they had expected a recovery in the back half of the year, but because of the high interest rates, we haven't necessarily seen that come to fruition?
Yeah, I don't think this is a surprise at all. In fact, we wrote a report about a week and a half ago. We called it a mid-year theme reset. And basically, we said for the second quarter, look for a slew of misses and guide downs. 80% of the companies that we covered guided to a back half recovery. And our call was that's not going to happen. So I suppose it's a surprise relative to 6 months ago, but relative to expectations, not a surprise. And in fact, the consensus estimates prior to today were actually below Home Depot's guidance. In other words, the street fully anticipated a guide down as we wrote about a week and a half ago.
So is this all macro, Michael? Is it still the high quality, Home Depot that you want to buy when rates come down? Or is there anything that they're missing when it comes to driving traffic and ticket prices in this environment?
Yeah, no, this is a macro rate call. We upgraded Home Depot in June after being on the sidelines for a while. And the call there was that bad news is good news. Consumer is slowing. The Fed is going to cut rates. When that happens, historically, Home Depot stock outperforms in that kind of easing environment. And we still think that will happen. On the call today, Home Depot talked about the weakness that they saw in the quarter. A lot of it was in the interest rate sensitive categories. And so as rates come down, those categories should improve. It might take a quarter or two, but we think the stock will anticipate the fundamental recovery by a couple of quarters. And in fact, we see it as a good sign today that this was a miss, at least on the comp line, and a guide down, and the stock is essentially flat. We think that's a bullish sign.
How much pent-up demand is there?
We think there's plenty of pent-up demand. They've been comping negative for, 2.5 years? So, it'll take some time, but when rates start to come down, we do think we'll see that return to low single-digit comps, probably by early, if not mid-2025. And again, we think the stock will anticipate that recovery.
Michael, is there a difference in the response mechanism to low rates between retail consumers and professional services, which has obviously been a focus for the company?
Yeah, well, ultimately, it's all driven by the same thing, and that's the consumer demand. So it's whether the consumer does it themselves or uses a pro to do it. So ultimately, we think the demand drivers are pretty similar in that sense, and lower rates should help. I suppose lower rates drive the bigger project sales, and that's more of a pro business than a DIY business. So that should have a little bit more leverage to the declining rate environment. But ultimately, it all comes down to the consumer investing back in their home as rates come down.
So who else is on watch now for decelerating trends into the end of the year that was feeling optimistic like this?
Yeah, like I said, 80% of the companies that we cover, so almost everybody. Maybe I'll say it this way: the two companies, at least that I cover from a big box standpoint, that didn't guide to back half acceleration and therefore were the estimates of safer, were Walmart and Dick's Sporting Goods of all companies. But almost everybody else guided to a back half recovery. We took our numbers down. We don't expect that. I think the good news is that I don't think anyone expects it anymore, and the street is sort of caught up to that. So expect guide downs, but we don't think that's going to have a huge negative reaction to a lot of names because it's already anticipated.
All right, Michael, really helpful to have your commentary today. Appreciate it. Michael Baker from DA Davidson.